Hello and welcome to this exclusive conversation on Nippon India Flexi Cap Fund. We are going through this phase of the market where there is a universal acceptance that things will look up in the near future, and that stands true as of now. And this time, the market messaging is very clear. That the tilt is towards the mid cap and the small caps, which have been in favor for quite some time now. Among the various equity mutual fund categories, Flexi Cap is the most flexible, which allows the corpus to be deployed across large, mid cap, and small caps based on relative attractiveness of the individual pockets. Nippon India Mutual Fund plans to launch Nippon India Flexi Cap Fund very soon. The NFO will open on July 26th and will close on August 9, 2021. To know the highlights and the features of this scheme, joining me is a very special guest, Mr. Manish Gunwani, CIO Equity Investments, Nippon India Mutual Fund. Welcome, Mr. Gunwani.
Hi.
Mr. Gunwani, to begin with, Flexi Cap funds lately have seen a huge interest from retail investors. So what is the reason for Flexi funds garnering so much of interest, particularly from the retail segment?
Yeah, I think there are a few reasons. One is that equities in general is getting a lot of attention. So we had a period about a few months back where mutual funds saw outflows. And then over last 3-4 months, we've seen inflows. The outlook for equities looks quite positive because the economy is recovering. Global economic growth is strong. The interest rates are such that I think a lot of people, when they're looking at their savings and the kind of returns they're making on the fixed income side, they're getting attracted to equities because equities has growth, whereas in fixed income, the real rates are quite low at this point of time. So overall, the environment itself is conducive for flows into equities. FlexiCap in particular, I think allows, as you mentioned, a lot of flexibility in terms of the fund manager to straddle different segments of the market. So if you see the history of the stock market, every 2-3 years, the dominant segment among large cap, mid cap, and small cap seems to change leadership. Sometimes large cap does very well, like 2018 and 19, right? Around 2013, 14, 15, small caps did very well. So this change in the leadership, the Flexi Cap funds can straddle and change their presence in different categories of the market to create superior returns and alpha. So that is why I think a lot of interest in Flexi Cap funds at this point.
Why do you think that this category of funds is relevant in the current market environment?
I think it's particularly relevant in the current context because if you see the performance of the 3 different segments of the market, the large cap, mid cap, and small cap, quite interestingly, 2018 and 19 large cap did well. Post the COVID meltdown in March 2020, we've had a phase where mid and small caps have done well. So if you see 1 and 3 year return, in 1 year, mid caps have outperformed large caps, but on 3 year, broadly, they are the same. So we have come to a point where maybe there's not so much of a very, very strong call between mid and small cap versus large cap. So I think investors are looking for a category which can be very nimble, which can be very dynamic, have a mix of large and mid and small caps. Essentially, what we are saying is our large cap exposure will have a certain range, which is 50% of the large cap exposure of the benchmark. So we have, first of all, defined a range in which we will be there in the large caps. Now, within large caps, we will have 2 categories. The first category will be the mega caps, which are the heavyweights in benchmark. So top 20-30% of the fund will be some of these mega caps, which are very big part of the benchmark. The rest of the large caps will be where we will look to make active bets, which should hopefully create alpha. Then on the mid and small cap side, which will be a big part of the allocation, at least to start with. There we are banking on our experience, track record, and research. So if you see, our mid and small cap funds have done very well over last few years, and we think we will be able to pick out secular growth stories, which will see, ideally when you buy mid caps, you want to hold on to them so that they compound and become large caps. So our team has been able to historically generate a lot of ideas in which that has happened. And our focus on the mid and small cap side will be these kind of growth compounding kind of stories, which should hopefully compound earnings very, very well, and grow their size, grow their earnings at a superior rate, so that it gives you good absolute return as well.
On what parameters will the stocks be shortlisted for the portfolio, and what are the big themes that you are working on?
So if you see, we have one of the widest research coverage in the industry. So we cover more than 530 stocks. And we intend to use a fairly bottom-up approach to decide the stocks and also the allocation between large and mid-cap. So wherever we see that there is long-term value, that a company will be able to compound earning, that is available at a reasonable valuation with good management, that is where we will go. So if you look at it, basically the mid-cap segment, if you take the mid-cap segment, essentially we are looking at 3 or 4 different themes. One is that with the economy opening up, last 15 months especially, outdoor consumption has been very subdued. So that is one theme we are looking at. Two is we are looking at a lot of new age business models which are coming into the market, right? Because of technology, because of the kind of disruption that is happening. And thirdly, manufacturing is another theme which we think still has potential. Obviously, a lot of segments within that theme have done well. But if you see the potential for value generation, if a lot of the segments of manufacturing moving from China to India is very, very vast. And therefore, we think some of the stocks in these manufacturing sectors still are very promising in the mid-cap space. Coming to the large cap side, again, couple of themes we're looking at is, one is there is a lot of consolidation in industry. So whether you take banking, telecom, etc., because of technology, because of the fact that GST or RERA, about pure digital companies, even in all big sectors, whether you take banking or healthcare, where a lot of large caps are present, picking up the company which has a great technology strategy, or which is able to use technology to enter adjacent areas and capture the profit pools which are adjacent to the main business. So that is the second. And thirdly, if the economy recovers, obviously the cyclicals will have a tailwind. So those are the kind of segments in the large caps we're looking at.
Mr. Gunwani, why Nippon India Flexi Cap Fund? Because there's lots of competition, and we have recently seen a very good mop up by some of the recently launched Flexi Cap schemes. So how is it different from the schemes and funds that are available in this category?
So you're correct that obviously there are a lot of schemes in this category. Where we think we will stand out is, one, as I said, in terms of our research coverage, in terms of our research experience, in terms of our track record in mid and small cap, I think we have a fairly demonstrated strong track record. Secondly, in terms of the active share, or how much our fund deviates from the benchmark. So generally, we are seeing a lot of funds in this category. They are very close to the benchmark. So when we say active share, it's basically how much are we different from the benchmark. So we intend to have a fairly high active share for this fund, where we, both on the large cap side and the mid and small cap side, we will make active bets, we will take bets on sectors, themes, etc. Where we think that the potential for creating big alpha is there. So this whole name itself, as it suggests, this is a fund we feel that we should be able to take a lot of thematic bets, lot of stock bets, where we deviate a lot from the benchmark and create substantial alpha. So that is where we think we will be different from other funds.
You just spoke about the themes that you will be playing around your consumption, your IT, manufacturing. Any of the new cyclical themes that you have identified in the mid-cap and small-cap space? Because so we have seen lately that textile is now coming up as a big sector where stocks have been doing well. Paper has come out with has been doing well. So any new cyclicals that you have identified in the mid-cap and the small-cap space? And overall, which of the sectors are you bullish on and the bearish on?
So in the mid-cap space, as I said, there are different themes. So if you look at the pure domestic economy, we are positive on themes where a lot of mid-caps are still quite cheap versus either the large caps in that segment, or there are no large caps in that segment because the leader itself is a mid cap. So if you look at commercial vehicles, real estate, cement, consumer durables, there are a lot of mid caps in these themes we are positive on, both because we like the company and also we think that the domestic economy will fire reasonably well over next 1 to 2 years. Other part is some of the segments you mentioned. Actually, we feel fall in that mega trend of manufacturing shifting from China to India. So in that mega trend, in a sense, we first saw chemical companies do well. We saw pharma API do well. But I think that theme seems to be expanding, also helped by the fact that the government is also pushing it through the PLI scheme. So we think that whether it's textiles or even steel or some part of the commodity basket, while they will obviously have their intrinsic cyclicality, because commodities by definition will be cyclical, textiles will be cyclical. But there is a structural component there that if the supply from China is kind of getting unviable or dropping out, then it's very positive for these segments in our country, because the size of market cap, if you take the size of market cap in textiles or steel today versus what is the potential, what is China manufacturing in terms of size, there is, we think, a lot of value that can be created. Obviously, given the cyclicality of these stocks, you also have to be a bit nimble because they go up and down a lot. So we will obviously have to calibrate that with the cycle. But yeah, from a multi-year perspective, we do think that this mega trend of Chinese manufacturing shifting to India gives you a lot of opportunities.
Markets are at record high, Mr. Gunwani. What do you expect from these levels? I mean, it's a broad-based rally that we have seen till now. So, do you expect the markets to, be in uptrend?
So, I think, as I mentioned earlier, basically the outlook for equities from a macro perspective is quite strong. So you have a fairly good combination of global growth being strong, domestic growth now coming back post the second wave. After many years, India is running, I would say, almost zero or negative real interest rate, right? Because your inflation is about 5-6%, your interest rates are 5-6%. Short term is actually less than that. Now that helps equities because inflation helps the top line of corporates, whereas the flows start moving away from fixed income to equities. And finally, even from a 5-7 year perspective, India has been on a down cycle. So your capex cycle is has a very low base. Your consumer discretionary has a very low base. if you see industry parameters like car sales or bank credit growth, last 5-7 years have been very, very weak. So this whole setup is very interesting, and everything will show up in corporate earnings. So the reason why we think equities look good in spite of the traditional valuation parameter like price to earning multiple looking high is that two big parts. One is we think over next 2-3 years corporate earnings will do really, really well. And second is that today equity valuation is more driven by the yield gap rather than price to earning multiple. So when I say yield gap, it is basically what is the earning yield on the listed stocks versus the bond rates or the fixed income rates. So if you see globally, all the big markets, whether it's S&P 500 or Europe or Japan, they are also trading at high price to earning multiples because of this yield gap or equity risk premium kind of method to look at equities. And I think that's theoretically okay. So both from a corporate earnings perspective and this perspective of seeing equities versus bonds or fixed income, we think that market still will give a good steady compounding return. It could be volatile because now the developed markets have reached a point where inflation and interest rates have started becoming concerns. So from April, if you see broadly, we've had a one-way market last April, from April 2020. We've not seen a very big correction, but we should expect to see higher volatility, which is also, I think, the reason why Flexi Cap funds today make more sense, because there may be periods of time where you see one segment getting overvalued versus the other. And then I think dynamically, if you can move across those categories, that should help creating a bit of alpha versus the benchmark.
One of the questions that retail investors ask is that what is the major difference between the Flexi Cap Fund and a multi-cap fund?
So today, if you see, as per the regulator's definition, the multi-cap needs to have a certain amount in large cap, mid cap, small cap, just 25%. So the mid cap, the multi cap category to a certain extent has become less flexible, that even if large caps look attractive or mid and small cap look attractive, you can't move a big part of the exposure to that segment, because by regulation, you need to have a good proportion in all the three buckets. Whereas if you see Flexi Cap, now ideally, for example, in Flexi Cap in 2017, and we could potentially have 95-100% in large cap. Then after the COVID meltdown in mid 2020, we could have potentially 90-100% in mid and small cap. So that is the overall construct. But of course, our own fund, we have put a certain range of large caps, which, as I mentioned, is 50% of the benchmark weight. So every fund will have some restrictions about how much they can move. But in general, the flexibility is much more than the multi-cap category.
Thank you, Mr. Gunwani, for being with us. It was a pleasure speaking with you. A nice insight into the Nippon India Flexi Cap Fund. Thank you so much.
Thank you.